So hi everyone, in this video we are going to be looking at support levels and how to trade these support levels. Okay, so what are support levels? Okay, so a support occurs when the market creates a low price level that the current market price movement fails to break. So for example, if the market is has come from this level, it goes high, okay, and then it comes back, hits this level, and then it goes high once again. So this means that the market has failed to break this previous level. So this previous level becomes a support. Okay. So when the market moves high, comes to hit this level. So this level was a support. After that, it goes high. If it comes back, hit this level and then goes up once again, it means that this level has been a support for 3 consecutive times. So this one becomes a very strong support level. Okay. So as you can see on this chart, so this line, the blue line, is drawn as a support because the market was going high, it hit this level, it went high, then when it came back to hit to break this level became a support. So it is a turning point which the market uses to go in an upward direction. Okay, so every time the price goes high, reaches a certain low, and then goes high, that certain low that has been reached is what we call the support level. So majorly, support levels precede a big price movement down or in a downtrend. So we get the support levels in a downtrend or in a short-term price retracement within this uptrend. So when the price is moving high, it goes down. When it goes down, it creates a support. So support, it means that the price has been held at that level to push it high again. The price goes down again, and then it reaches a level which it hits to go high again. So that is the support level. It is normally preceded by a big move up or a short-term downtrend or what we call a retracement within an uptrend. So support levels are bullish reversal signals. What do we mean? So for example, if the price is moving high, then reaches a certain level, and then it goes high and then reaches a certain level, you can see that for every time we form what we call a support, lower price level that the market cannot go below is what we call the support. So if this is going to become a support level, the price is expected to go high. So that's why support levels are considered as bullish reversal signals. So for example, you can see here that if the price hit this level, it became a support. And then when the price hits it once again and bounces off, so this means that here we are going to get what we call a bullish signal. So it becomes a bullish reversal signal. So when the price is coming, here it is going down, but here we have our support level. So it means the price is going to go high again. So the support levels become reversal signals into the bullishness. So we draw basic support levels using slabs, or you use lines on a line chart and instead of candlestick charts. So what happens, we shall see this later in the video, is that when we are drawing clear support levels, we normally better use what we call the line chart. So for example, if this is our line chart, okay, if this is our line chart, we can look for points whereby the market used to go high. So for example, this point, let me draw it better. So for example, if you have our chart right here, and then the price is moving high, so if this is our line chart, okay, so we want to locate the support levels. If we are going to draw support levels, we shall draw them at these turning points, okay. So here we shall draw our first support level. Even here we shall draw our first support level. So here we shall have a support level. Even here we shall have a support level. So after drawing these support levels, we can then go back to the candlestick chart, and you can see that this support level connects to this one. So we either use lines like that, or we do not use lines and we use what we call the slabs. So slabs look like if we are going to draw a support level here, we shall draw it something like that. So that could be a slab, okay? Some people call them shapes, painted like this. So that could be our support level. Even here, when you're going to draw the support level, we will draw it like that. So after drawing them on a line chart, then we switch to what we call the candlestick chart. So here we expect the price to come, hit our support level, okay, and then bounce off. If not, it will come and break the support level, okay. Expect to retest the support and then go down, okay. So that is what we call drawing the support levels using slabs or lines. So moving averages can be used to make dynamic support levels in an uptrend. Dynamic means changing, okay? So for example, if we have a clear uptrend, and I have already made videos about the uptrend, downtrend, and then consolidation, you will find that on this uptrend, when you put on moving averages, they'll be moving in a clear pattern like this, with a low moving average being higher than the higher moving average. So for example, this could be the 6 exponential moving average, and this could be the 20 exponential moving average. And then here we would have another moving average. Let me say the 50 exponential moving average. So a lower moving average is always on the top in an uptrend, and the reverse is true for the downtrend. So when the price is moving when the price is moving in an uptrend, it will come and find support on the moving averages. So for example, here the price finds support on a moving average, it bounces off the moving average, goes high. So here it will come and still find support on a moving average, and then goes high. Here finds support on moving average, and then support on a moving average. That's why we are saying that moving averages can be used to find the dynamic support levels within an uptrend. So when drawing support levels, we avoid market fluctuations and we consider them as minor support levels. What are market fluctuations? So when you look on this chart right here, so for example, this is a line chart, and we can see that the price has moved higher compared this. If this was $5, here it could be around $20. Okay, so it means that this is an uptrend. But when we're doing the support levels, we have ignored this level here. This is a market fluctuation. And then on that same, we have also ignored this level here. There's a market fluctuation, and we have also ignored this level. But it doesn't mean that this level is useless. So this could be considered as a minor support level, whereby this price could come and hit this level and then create a new trend. And then here it creates a new minor support, and then comes retest that level and then move high. So another type of market fluctuation is whereby, so that's why we draw these supports using line charts to avoid market fluctuations. You can find that a market is in this format. Okay, so when you look on this chart, we are going to connect to this level right here. We connect it to this level and then connect it to that level. So you can see that we are leaving out this level and we are also leaving out this level. So when we connect this one, it creates a clear support level. But still, this is now a market fluctuation. But its turning point is not useless. It becomes a minor support level. Even here, this one is going to be a market fluctuation, but its turning point is going to become a market fluctuation, and it is going to be considered a minor support level. So we shall be seeing this more on a candlestick chart later in the video, okay? So the more a support level is retested, the stronger it becomes, okay? So for example, here, this one has become a strong support level. So for a support to be considered a strong support level, it should be tested at least 3 times. So for example, if here you have a support level, we expect that the market is going to come, bounce off, bounce off, bounce off, and then bounce off. So you can see that the market has tested this support level 3 times. So this is now considered a very strong support level. So when the price hits it again, we expect a bounce off, and even here we expect a bounce off. Okay, so the more a support level is tested, the stronger it becomes. So support levels in higher time frames are stronger than support levels in lower time frame. Okay, so this is very clear. We are saying that if this support level is within the H1 time frame or the hourly time frame, it would be stronger if this support is created in an H1 time frame. It would be stronger if created in the 5-minute time frame. And so the same thing, if it is created in the monthly time frame, it would be stronger than in the H1 time frame. So the higher the time frame, the stronger or the more confirmation for that support level. When price breaks through a strong support level, it is followed by a strong move down. Okay, so what we are saying is that, so for example, if the price has been finding support on this level here, and then this level becomes a strong support level, okay, so when the price comes and breaks this level, it will be followed up by a very big wave down or a very a long-term downtrend, and then it could come and retest it and then continue its downtrend. So when a strong support is broken, you always expect a strong wave down, or you always expect a strong downtrend. Okay. So when price breaks a support level, the broken support may eventually become a resistance. So we are saying that if this is our support level, and then the price goes high, comes test a level, goes high, if it breaks this level, it will come back and test this level. So after testing that level, this level becomes a resistance. So we shall be looking at resistance in the next video. So when a support is broken and tested, it becomes a resistance. So resistance occurs when the price makes a higher level, which it fails to break, and then bounces off that level. Okay, so this one is a resistance. But when the price is moving high and creates a lower level that it fails to break, it becomes a support. So you can see that here the price moves down, it goes high, it hits this previous support, okay, and this previous support creates a high level that fails to be broken, and then it goes right down. So that one becomes a resistance level. So we can trade them in 3 major ways. We have what we call the bounce off strategy. So bounce off strategy is whereby we expect the price to keep on bouncing off the support level. Price goes high, comes to the support, breaks, it fails to break, and then it bounces off the support, goes down, reaches a support level, fails to break, goes high, fails to break the support. So we trade these ones by making buy orders from this support level using either candlestick patterns or different indicators. So here the price is on a support. We expect it to bounce from the support. So we would make our entry point from here up to here. Entry point when it bounces off the support up to here. Entry point when it bounces off the support level. Or we can also make a trade on a bounce strategy in this format. Why? Because here we have a support. So here we have a support. So when the price goes high, goes down, it creates a support level. So we make our entry here. It goes high, goes down, creates a support level. We make our entry here, goes high, goes down, creates a support level. So we make our entry from here. So this is normally best picked using moving averages. So another format is to trade the breakout strategy. So breakout strategy is where the price breaks the support level. So here, for example, the price is finding support at that level. Okay. So when the price breaks this support, we make our sell entry here, expecting the price to keep going down. Okay. Or else we can trade these ones using what we call the break and retest strategy. This is whereby the price is finding support at a certain level. For example, here, price finds support here, again support. So when the price breaks the support, we don't make an entry, but we wait for a retest onto this support and then a confirmation. So we make our sell entry here, and then we could be able to catch the wave down. So those are the three major ways of trading support levels. We have the bounce off strategy when the price is bouncing off a support, for example here. And then we have another one whereby the price breaks the support, we make our sell entries, or we wait for the retest, what we call the break and retest strategy. So that is it. We continue with the video. So we are going to be looking at the bounce off strategy. We want to see how we can make entries from a support level using this bounce off strategy. So for example, we said the price makes a low that it fails to break, and this creates a support level. So for example, right here, you can see that this is a clear support level. And then we also said that we can draw these support levels using lines, but we normally use a line chart for better results, or if not, we wait for this, or we can use what we call the slabs. The slabs are always, they are painted zones, okay? So for example, here we could draw a slab like that. So this could be considered our support level. So for the bounce off strategy, we wait for the price to create a support level first. So you can see here that the price was dropping. It found support at this level and then it goes high. So here we don't trade because it is not yet a confirmed support. So when the price comes back to that level, that is when we wait for an entry. So for example, here, if we see that right here we have a level that has been felt to be broken to go upwards. So we target that the price is going to bounce off from this level, okay, and then go back to this level. So here we could make an entry from here and then catch some short pips or short profits. So when the price reaches there, it comes back again to the support. We make an entry from here to go there. So still the price goes to this level and then we catch some small pips down. So you can see that here the price came back to retest the level, but it failed. So it means that the price has created a new support level. So what we do is we draw a new support level right here. Okay, we do not enter that trade until the price has hit our proven support. So here that the support was proven because it was tested 3 times. You see, 3 times, but here it has not reached onto this level, so we don't make an entry, but we consider this as a new support level. So when the price goes high, it goes back to this support, so we could make our entry from this level. That is what we call the bounce off strategy. And we wait for a candlestick pattern in most cases. So we wait for a bullish candlestick pattern. So for example, now here we have this new support level, and then we have this bullish candle, which is big, which preceded a doji. If you didn't watch my series about the candlestick patterns, I advise you go back and watch them. So we could put our stop loss below here, and then we could be able to catch the wave up. So here the price goes back and hits the support and followed by a bullish engulfing. I don't know if everyone can see this bullish engulfing. This is our support. Price goes, test the support, we made an entry, go high, price comes and tests the support again, creates a bullish engulfing. So this was our entry point, and then we target the new levels created high here. Okay, so still the same thing could happen right here. You can see that this level failed to break here. Okay, so if you're going to use the slabs, we could, some people call them triangle shapes, stuff like that, but I would just like to call them slabs. So this could be our support level. So when we draw our support level, we are waiting for the price. This price here has tested this level and failed to break it. So when the price goes high right here, okay, so we expect that the price is going to drop. After the price drops, creates a support, so we mark this support level. Okay, so right here, all this which is happening, we don't know because it is in future, it has not yet happened. But when the price comes back onto this level right here, and then it creates a candlestick pattern, and we can see that right here there was a bullish engulfing, and this bullish engulfing also preceded this hammer. You can see that here there is a hammer, so we had to make our entry point from here. Our stop loss 1.5 of the of the ATR, and then we could be able to catch the wave up. So still the same thing happens here. You can see the price tests this support level. Okay, this was our support. So price tests a support, it creates this hammer. So we could make an entry from here and catch the wave up. So here we are waiting for the price to come and then hit our support level to create a candlestick pattern, but there was no candlestick pattern, so there was no entry. Okay, so some people were so aggressive that they make orders right as soon as the price hits the support level, but I don't advise it because we could get a breaks and we lose money. So you have to wait for candlestick patterns. For example, you can see here that we have a hammer followed by a bullish engulfing, and then still here we have some dodges and then a hammer, and then here this was our first level to confirm that we have a support here. So when the support is hit 2 times or 3 times, so it becomes more confirmed. You can see that here it was tested 3 times, and we said that when the price breaks through a strong support level is a level which has been tested several times. So here it was tested 3 times. We expect a big wave down. So here we could make short entry because the price broke through this support level. Okay, so that is the bounce set of strategy part 1. Okay, so we have said that in recap that when the price is on a support level like this, the price comes, it comes to hit the support. So after we have confirmed that here there is a support, we wait for the price to bounce off this level, and when it bounces off, it creates a candlestick pattern. So we make our entry above the candlestick pattern and then catch the wave up. When the price comes back again, bounces off with a candlestick pattern, for example, a bullish engulfing, for example, a hammer, for example, a doji, for example, a bullish kicker, for example, a morning star pattern. So if you didn't watch video about the candlestick patterns, I would advise you go back and watch them. So after forming a candlestick pattern, then we catch the wave up. We wait for it to test the level again, create a candlestick pattern once again, and then we make an entry to catch the wave up. If the price comes and breaks the level, we do not enter. So this could be a different strategy called the breakout strategy. But sometimes you can see the price breaks but still comes back with a very strong candlestick pattern. So here we just make an entry because this one here is going to be considered a market fluctuation. So we said market fluctuation is whereby the price pierces through the support. So for example, right here, you could see that instead of bouncing off this support, it would come and create this market fluctuation. So we just have to ignore these market fluctuations and mark them as minor support levels. So we are looking at bounce of strategy part 2. So bounce of strategy part 2 in support levels occurs in a clear uptrend, and a clear uptrend we said is signified by series of higher high and then higher low. If you didn't watch that video, I advise you go back and watch it. So you can see that here the price goes high. Okay, it creates a level, it fails to break, goes down, creates a support, goes high, it comes back to test this level, which this level is on which becomes a support. So when the price hits this level, we wait for a candlestick pattern and then catch the wave up. So that is what we are going to be looking at. And this one is best traded using moving averages. So for example, you can see that right here, we have a big wave up, a higher high, creating a higher high, then a wave down, goes high again, goes down, and then goes high once again, then it goes, and then we expect to go high once again. Okay, so we want to see the major turning points. Here we can see that the price is forming support at the moving averages, and we said that support levels can also be marked using these moving averages, and we mark them as dynamic support levels, these levels that will keep on changing. So when you look here, you can see that, for example, here you can see that here we had a support. Here you could catch a bounce of strategy, come to this level here because of this support 1, 2, and then 3, followed by this candlestick pattern called the 3 white soldiers. Okay, so here we are looking at a moving average first. When the price fails to break a moving average and then creates a strong candlestick pattern. So for example, you can see that here on the green line we formed this hammer. Okay, but this hammer So we had to make our entry point on a confirmation candle, which is the next bullish candle. If you didn't watch video about the hammer, I advise you go back and watch it so that you learn the entry points for hammers. So here we have a strong bullish candle. Our entry point would have been right here, and then we target this price. Okay, so you can see that still after failing to come up here, it created what we call the bullish engulfing. Okay, so this blue candle's body covers the entire body of this previous red candle. So here we have to make our buy stop order, stop loss 1. So right here we could make our buy stop order, stop loss 1.5 of the ATR, and then we could be able to catch the wave up. So after here, we could see that this is a confirmed support on this green line. So here the price still hits the green line. You can see the price hits the green line right here. It forms this bullish engulfing. After forming the bullish engulfing, we could make our buy stop order and then catch the wave up. So right here, the price still goes down, but here there is no candlestick pattern, as you can see. If there was a candlestick pattern, we would have made that trade, okay? And for this strategy to work best, the retracement is supposed to be a Fibonacci level, 38.2, 61.8 levels, okay? This level here. So you will use, if you don't know how to use that Fibonacci, you can go to my channel. There is Fibonacci levels. You check under videos. So you go swing high, swing low. This level should be Fibonacci level. So your price goes high, it goes low, find support at a moving average, and there is a Fibonacci level. Wait to form a candlestick pattern. For example, a hammer, a doji, a tweezer bottom, stuff like that, and then you could be able to catch the wave up. So that is the bounce off strategy using moving averages. Okay. So if not that, you could wait for something like this. If you don't want to use moving averages, price goes high, creates a support level. When a price is going to move high, we expect it to break this level of resistance. So when the price comes back to retest this level, that is when you make your buy order after forming a candlestick pattern. Then price goes high, you wait for it to come and test this swing high, and then, for example, it tests, creates a candlestick pattern, and then you make a buy entry. But moving averages look simpler. So we are going to be looking at the breakout strategy. This is whereby the price breaks a support level. Okay. So for example, you can see that right here we have a support right here. Okay. But on this support level, you can see that we were waiting for the price to break through the support, but it failed. Okay. This support level here. Okay. So when you look at the chart, still here we have some support levels. You can see that here the price was moving high. The support started from here. This was the turning point 1. Then it goes down, creates a turning point, swings high, comes and then creates a turning point, swings high, comes down, creates a turning point, swings high, then turning point. So this is a very strong support level. Even here it was tested. Even here it was tested. So this is a very strong support level because it has been tested so many times. So what happens in this breakout strategy is that we wait for the price to break through this support. When the price breaks through the support, we put a sell stop order, and then we expect to catch the wave down. So the wave down we are going to catch is always big, or is always dependent on the strength of the support. If the support level is very strong, then the wave down is also going to be very strong. But there is only one catch. In most cases, when the price breaks support level, it comes back to retest this level to become a resistance, and then the price could move down. That could be the structure formed. So here you have a support, okay, and then the price breaks the support level. The price will come back to retest this level and then create a new wave down. So, or sometimes the price will come on the support, break it, but does not come back to retest clearly, and then it comes back later, and then we could be able to miss this, but it is still okay. It depends on the appetite of risk you want to use within your trading. Okay, so when you look here, the retest was not accurate, but if you use slabs, the retest was accurate. Here you could see that there is a retest here on a doji, so this was our entry point. But if you're using the breakout strategy, you can see that here you have your support, okay, and after this candle here totally closing below the support here, that is when we make our entry point. So if you have a support level like this, okay, you have to wait for the price to come and break this support. When the price breaks the support, that is when you make your entry point. But what you have to do is to make sure that when the price breaks the support, the candle which has broken the support has totally closed below the support. So we make our entry on the candle that closes totally below the support level. Okay, so for example, right here you could see that the support level was passing right here. So this was supposed to be the entry candle, the candle that closes totally below the support level. So we make our sell stop order from here. Stop loss is 1.5 of the ATR, and then we could be able to catch the wave down. Okay, so that is the breakout strategy. In the breakout strategy, we don't wait for a retest. Okay, so we are going to be looking at the break and retest strategy. This is whereby the price breaks a support level, comes back, retests it, and then it could be able to make a new wave down. So for example, when you look at the chart right here, if this was our support level, for here it was tested one time, second time, then third time. So this is a confirmed strong support level. So here the price breaks out on this blue small candle you're seeing, because it is a candle which has totally closed below the support level. So in a breakout strategy, without waiting for a retest, we could put our sell stop order here. Price stop loss is 1.5 for the ATR, and then wait to catch a big wave down because it was a very strong support level. So for the retest strategy, we have to wait for a retest. The reason as to why you wait for a retest is because sometimes the price comes on a support level, tends like it is breaking, and then it comes back up, and then you make losses. So this is what I call the market fluctuations. So the price will create market fluctuations, comes back and stop you out, and then comes back and then create what you wanted to see. So after this support level right here, we have to wait for the price to break the support and retest, then create a candlestick pattern, and then we could be able to enter on the candlestick pattern. So you can see that right here we have 3 series of bearish candles. This is what we call the 3 black cross. If you didn't watch that video, go and watch it, and then you see where we make our entry point. So this was our entry point, and then we catch the wave down. So right here we still have a support level formed right here. So this is what I call the market fluctuation, when the price pierces through the support. Here market fluctuation, and then even here market fluctuation. So you can see that here we have a very clear support level. Okay, So the price hits the support, goes high, support, 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 here support, then support. So you can see that this is a very strong support level. Okay, this level here is a very strong support level. So the price finally breaks the support. So we are waiting for a retest on the support. Then we confirm with a candlestick pattern, and then we could make our entry to catch the wave down. Okay, so how to take profits, I'll make another video about that. So you can see that here when the price broke through the support level, okay, it did not come back to retest that fast, but it went down, but finally it came back to retest on that level of support to become a resistance, and then it formed a candlestick pattern. Here we have these two dojis. I don't know if you could see them clearly, and then followed by this confirmation bearish candle, and then the price goes down. So when the price comes back to this level here, this is the resistance, this new level of resistance formed, and then it bounces off with a candlestick pattern. We could still make our entry point from there and then catch the wave down. So that is the break and retest strategy. Okay, so we have looked at 3 strategies for trading these support levels. One is where the price is bouncing off a support level. Okay, so for example, this is our support. So we wait for the price to move high, then comes back to retest, creates a candlestick pattern, and then we enter from the candlestick pattern, hits a support, creates a candlestick pattern, then we make an entry. That is one. Or another one is where the price is making a series of higher highs and then higher low pattern. So here we use moving averages to pick these dynamic support levels. So the price will tend to bounce off the support using moving averages. So the price finds support at a moving average, creates a candlestick pattern, and then we make an entry to get some short pips. Okay, so another type of trading on support levels was the breakout strategy. So breakout strategy is whereby we don't wait for the we don't wait for the price to test this level of support. And when the price breaks through the support, we wait for a candle that closes entirely below this level of support. That is where we make our entry point to catch pips down. So here we don't wait for a retest, okay, because sometimes the price will make a retest and then sometimes the price will not make a retest, okay? Or there is a final strategies whereby we wait for a retest. When the price breaks a support level, it goes down, comes back to retest on the previous support to become a resistance, and then it creates a new wave down, okay? So the longer the support is tested, the stronger it becomes. So I think that is all on support and resistance, on the support levels. So that's the 3 major ways we can trade them. We shall be looking at them more on professional videos on how to capture these profits. I don't recommend you to use this video to go and start trading support levels because we have not confirmed different strategies and we have not yet backtested them. But they can give you clear guidance on how to view life using these support levels. You can trade the bounce offs. So for example here, okay, when you look at this bounce off, if it was on a daily time frame, so this is the H4 time frame, but if you could go down on a minute 15 time frame and look at this wave here, it is a very full trend, and this is also still a very full downtrend. Still, this is a very full trend. So all these will be explained in professional videos to come. So thank you so much for watching this video. Do not forget to subscribe to the channel for more videos like this and for support. I'll see you in the next video. My name is Jordan. Bye bye.